Hi guys, welcome to Medicine with JYK, and today we'll discuss a little bit about the Chinese real estate market. Um, More specifically, this will be a discussion on the the ways credit plays a role and like how mortgages work in China and how that might affect um, people's behavior, banks' behavior, and how the this whole real estate bubble is going to play out. So yeah, so it's just a discussion. I don't have a particularly strong view on a lot of these things. So in China, um, it used to be the case that the um, down payment was 20%, and uh, if you look at this, since 2015, it was a no less than 25% down payment for commercial mortgages. And so here again, there's a difference between commercial mortgages and what's known as, I don't even know how to translate it. It's probably called like Provident Fund real estate. Provident Fund like accommodation mortgage or something like that. So basically, if you are an employee working in China, you have to pay into this thing called a Provident Fund. I think you have to pay like 5% of your salary or something into it, and the amount that you pay into it determines uh, to an extent how much money you can borrow with this Provident Fund mortgage, which is cheaper and then it has a different down payment requirement. So it's all very complex. But I don't even know if this Provident Fund thing has any other uses that's not a like cheaper mortgage. But in any case, so that's 25%. But then that's for the first first apartment, or however you call it, the first piece of real estate. And there are at least four cities, Beijing, Shanghai, Guangzhou, and Shenzhen, that uh, are known as limited purchase cities, or however you translate that. And these have a 30% limit on the down payment. So you have to have at least 30% down payment if you were to buy the first piece of real estate in those cities. These are also known as Tier 1 cities. And yeah, and the other thing is, if you, according to this, if you have had a mortgage in the past and you paid it off, and you want to get a new place, like a better apartment, right? So in this case, it will be 30%. So the banks will know because you have there's a record in the credit report, and the bank is obliged to do 30%, at least 30%, because that's what the government says. And what else is there? And then the so-called first piece of real estate is per family. It's not per person. Um, yeah, and then you have to be more than 18 years old. and it has to be less than 90 square meters. Otherwise it's 30%. It's like 30% down payment. Also, the interest rate is higher. So there's like a bunch of crazy things in here that determines what counts as the first piece of real estate. And then other things, if it's a second piece of real estate, it gets a lot more stringent. So in Beijing, the down payment is 60% or more, and mortgage duration is no more than 25 years instead of 30 years. So basically, I am mostly agreeing with what the government is doing in terms of trying to make the places a little more unaffordable to speculators, because it's quite expensive to, in this case, to lever up, and also your cash flow requirements goes much higher. Also, that if in case you default, the banks have like a 60% buffer, right? So you can give up your apartment, and then the apartment price drops by 50%. The bank still doesn't lose. So that's the crazy part. But I think high down payment is really, really important in this case. By limiting the supply of credit, it seems like a correct way of addressing these issues. And yeah. And here is another thing that says basically it's like 60%, right? So quite crazy percentages. But for non-first tier cities, the second piece of real estate, second mortgage, can have no less than 30% down payment. And for all the first tier cities, because the one we saw just before was Beijing specifically, but for anything that's not Beijing, it's no less than 50% down payment for the second piece of real estate. And yeah, and so in terms of here, in terms of mortgage interest rate, there are a couple of things that's interesting. First of all, there's this base interest rate, and it goes to, this is set by the People's Bank of China, I think, and the annual interest rate is, for anything that's more than 5 years, it's 4.9. But if you were to make it a mortgage, which is supposedly going to be like 30 years, there is a multiple that's applied to it. So depending on the bank, so HSBC charges 1.1 for 1.1 times the 4.9 for the first piece of real estate in Beijing, and for the second piece of real estate is 1.11. Right, so it's slightly higher. And the other banks, the Chinese banks, goes from 1.05 for the first piece of real estate, which is lower than HSBC, but for the second piece, it goes to 1.2 times, so 5.88. And you can see here, for the Beijing's Provident fund mortgage, it's 3.25 for the first piece and 1.1 times that for the second piece. And it's also going to be city specific, but they're typically the same in this case. And the limit for the Provident Fund, I think, was something like around $100,000 per person, and you can combine it for a family, so $200,000 per couple. And average apartment price in Beijing maybe is around, I would say, close to $1 million. So yeah, this thing is not gonna cover the whole thing. So you have to combine the Provident Fund mortgage with commercial mortgages. And the other pretty fucked up thing that is very different from US is all these are floating rates. So whenever PBOC increases rates, the payment for all mortgage holders will go up. The monthly payment will go up. So I thought that was quite crazy, considering a lot of middle-aged Chinese people have, they are already pretty close to the edge in terms of cash flow. They don't have that much left because most of that goes to the mortgage payment. So yeah, so that's quite crazy. And then you don't get fixed rate. It's not that you choose a floating rate. You don't get fixed rate mortgages. So that is the crazy thing, I think. But combine all this information together. So let's try to picture what the whole market is like. You got the government that's trying to control the market. They did some pretty drastic measures, for example, by moving the second piece of mortgages down payment to more than 50% for the hottest markets, the tier 1 cities, Beijing, Shenzhen, Guangzhou, Shanghai, these cities. And by doing that, it severely limits the amount of credit one can obtain. And also it protects the banks in case of defaults, even if the price of these real estates go down. And the big boom, I think, happened after 2012 as like a side effect of the crazy stimulus package that the government instituted to counter the Great Recession, the credit crisis in this world. And that started happening in 2012, and then the price just kind of kept climbing. And the last time PBOC increased rate was 2015. So people have been having 3 good years of essentially fixed rates. And who knows what's going to happen if PBOC keeps pumping rates up, because the Fed is increasing rates, and if PBOC wants to defend its currency, at some point it will have to increase rates. But again, the Chinese economy at the moment is a bit finicky, so might not be the best time to increase rates. And in terms of this, I think people are predicting some kind of crazy real estate burst in China that is gonna screw all the banks and fuck up the entire economy. But I think it's less likely. First of all, you never get zero down mortgages, so the supply of credit is always somewhat constraint. And because of the large amount of equity one has in a in each piece of real estate, when someone defaults, they bear the brunt of the damage. So you will have a lot of people that, if the housing price comes down, 20-30%, which was basically what screwed up the U.S. Mortgage market. But that's very unlikely to happen in China, because anyone that has more than one piece of real estate has like 50%, at least 50% equity in that real estate. And then the first, the people that have just one piece of real estate, one mortgage, they're very unlikely to default, because they live somewhere anyways, right? So the incentive is just not there. They probably just keep paying and just stick it out. All they need is a way to sustain their cash flow, and that the government can influence by lowering the rate. It will also lower the amount of monthly cash flow requirement one has to pay the mortgage. So overall, I don't think the Chinese real estate situation is as dire as either Japan in 1980s or US in late 2000s. Yeah, so that's basically what I think. So I thought this might be useful in order to understand one aspect of the Chinese real estate market. And yeah, see you next time.